So if I were to lose everything and start again, here is how I would invest my first £100 and beyond. So this is my trading 2-on-2 stocks and shares ISA. Currently, I have a balance of over £100,000. Now, many will agree that the first £100,000 invested is the hardest to get to. And after you reach that tipping point, everything gets easier. A 1% gain in that portfolio is equal to £1,000. Now, what would happen if I had to, let's say, either withdraw all my money or it went down to zero for whatever reason? How would I start again? Now, one thing that I would not do if I had to start again from zero is to pick individual stocks. That is what I first did when I started out investing, and I lost thousands and thousands of pounds like that. Now, the second thing that I wouldn't do is to try to time the market or anything like that. So in this video, I'll show you how I would invest my first £100. As always, I'm going to be using the Trading 212 app. And if you would like to sign up to Trading 212 and receive a free fractional share worth up to £100, all you have to do is to click the link in the description box down below. Alternatively, if you've already signed up to Trading 212 in the past 10 days but haven't received your free fractional share, all you have to do is to press the 3 horizontal line menu over here. Scroll all the way down until you see the section use promo code. And in this menu, just enter the code JUBAIR and you should receive a free fractional share. So the first thing that I would do if I had to start from zero, unfortunately, I can't just delete all the money that I have here. But the first thing I would do is to make sure that I'm using the Trading 212 stocks and shares ISA and not the invest account. Now, I actively use both accounts, but that is because I have more than £20,000 that I invest per tax year. If you are investing less than £20,000 of fresh money per year, then you really don't have to worry about using anything other than the Trading 212 stocks and shares ISA. If you have a cash ISA somewhere else, that could take away from the ISA limit. Now, as you can see from here, every single tax year that runs from April the 6th to the next year's April the 5th, you have £20,000 of fresh new allowance that you can put into your stocks and shares ISA. This £20,000 deposit allowance, usually it's not called a deposit allowance, but realistically it is a deposit allowance. This is shared between all the different types of ISAs that you can open. For example, a cash ISA, lifetime ISA, and some other types of ISAs. So do bear that in mind. If you have any other ISAs, they will share that £20,000 limit. Also, Trading 212 does not know if you have deposited into other ISAs, a cash ISA or a stocks and shares ISA with a different broker. This tax year, I have, for example, maxed out my ISA with 2 other brokers, but Trading 212 will not know that, so it's up to you to manage these limits. Remember, this is only a deposit limit. It doesn't mean that you can't invest more than £20,000. Like you can see here, the value of your portfolio can be well over £20,000 if you make those gains, and any deposits on previous tax years, they are allowed to stay in your ISA and grow indefinitely, meaning, you can make as much gain as possible. And my goal is to have at least £1 million in my stocks and shares ISAs combined so that I can retire early. So now that being out of the way, if I had only £100 to invest, this is what I would do. I would go into the magnifying glass menu over here. Now, what I would do is to completely skip any of the stocks and shares that are individual companies. Now, I firmly believe that you can make a lot of gain by investing into individual companies. But the thing is, there is a lot of risk when it comes to investing into an individual company. Now, even if we go into a company like Nvidia, which has been doing exceptionally well, there is no guarantee that this company will continue improving its earnings, beating profits, and continuing to pioneer in their selected field. Now, for example, if Nvidia kept missing their earnings, their profits plummeted, or their competitor started making better, cheaper, more reliable products. So what could happen is that investor sentiment can degrade. Investors might want to pull out their money from Nvidia. Essentially, the stock price will reduce. And if you have all your eggs into Nvidia, you will either lose a bunch of money or eventually the company might go bankrupt. So there is a lot of risk when it comes to individual stocks. But in the opposite vein, when it comes to the stock market, not always, but a higher risk can sometimes lead to higher potential returns. It does not always work like that. Sometimes you can have high risk and low reward. So do bear that in mind. So if I'm not going to be investing into individual companies, then what am I going to be investing in? And the answer comes over here when we look at ETFs. Now, an ETF stands for Exchange Traded Fund. A fund essentially is a collection of stocks and shares, and ETFs are traded just like stocks and shares. You can buy them and sell them when you want. So they kind of act like one company, but instead of just being one company that you're invested into, you are invested into multiple different companies. Now remember, just because you invest into an ETF does not make it a good investment. It's very similar to saying that I've invested into cryptocurrency. Just because it's a cryptocurrency does not make it a good investment. You have to look at the underlying utility of that asset. However, the difference between an ETF and a normal stock is that the ETF is diversified. Remember, some ETFs are more well diversified than others. You can have ETFs that track a specific market and have very low diversification. So remember, do your own research when it comes to investing into anything. So now that you know that I would invest into just ETFs, I would invest into just one to make my life as simple as possible. Now, if you scroll down on most popular, you will see a bunch of ETFs. Now, just because something is popular does not make it a good investment. But you will see a recurring theme. You will see a lot of S&P 500, and that is basically a fund that invests into the top 500-ish companies of the USA. I say 500-ish because there are sometimes more companies than 500. You'll also see a bunch of other ETFs, but I'm going to ignore all of them and go back a step. So I'm going to go back here, and in the search menu over here, I'm going to type the words All World. Now, once you type that in, you'll see a narrowing of results, and you can see here there are some All World ETFs that you can invest into. Now, obviously, I don't want to be giving out any financial advice or anything like that, so I'm just going to go for the top one. I have to reiterate that you have to do your own research before investing into anything. Now, here is the Vanguard FTSE All World. So this is an all world fund that you can invest into, and in brackets it says ACC. Now, what you have to realize is that in the stock market, some companies pay out a dividend for you holding shares in that company, and ACC basically means that these dividends that are paid out in the fund, those are reinvested back into the fund, so the value of the fund should go up. I received a comment recently saying that the number of shares in the ACC fund isn't increasing, and that will actually never happen unless you make the active choice of buying more shares. So the number of shares don't increase. Those dividends that are paid out from the companies that the fund holds, these dividends are reinvested back into the fund, and you don't really see when these decisions are being made. But anyway, as you can see from the title, this is an all-world fund. Now, if we scroll down on Trading 212, right at the bottom, it does say fund allocation. We're going to want to press see all. Now, over here, it does give you the top 10 holdings of this fund. You can see very heavily invested into the USA. We have companies like Apple, Microsoft, Nvidia. So what we actually want to do is to press countries at the top. There is a tab, and over here we can see what the fund actually invests into in terms of different countries. Now, like I said, I want to invest into just one ETF, and I want to make sure that that ETF invests into a range of countries across the world. So instead of trying to time the market, or instead of trying to predict what country is going to do best, I would rather just invest into everything, because I know from history that the world improves, and I would love to get a return on my investment as the world improves. So we can see under countries, we have a very high weighting towards the USA, which is very typical for an all-world fund. This is because the USA is the major driver for economic growth around the world, or in other words, it has the largest GDP. We can also see we are invested into Japan, UK, China, France. Now, if I'm happy with the allocation, I can actually purchase this fund. What I also do want from this fund is to have a nice allocation towards emerging markets such as India. This is because countries such as China and India have an incredibly large population, and I don't want to miss out on any advancements that come from such a high concentration of people. Now, once I'm happy with that fund, I know where my first £100 will go into. Now, I am not giving anyone financial advice, neither am I tied to any fund provider. For example, I am not being paid by Vanguard I'm not being paid by Invesco to promote any of their ETFs. Now, I would probably just skip out on Vanguard and go into Invesco. I have no affiliation with Invesco, but the more research you do, the more you realize that some of these funds are cheaper than the others. Now, if you are holding something for the long term, which I would fully intend to do if I had to start from zero, the fees that you pay can etch away from the total returns that you get in, let's say, 20, 30, 40 years. This is why you'd want to go for a fund provider that has the lowest fees. But remember, just because a fund provider has low fees, they might make other cost-cutting benefits somewhere else. So it's up to you to do your full research on what the fund invests into, what the fund costs, and sometimes even performance figures for the funds, and you can do your own comparison on that. But I've already done my research and I like this ETF for now, so what I would do is I would press buy. Now, instead of trying to time the market with a limit order, I would just buy it at the market. I'd put £100 in and review order, and I'd send that buy order, and that would be my first purchase of £100 invested. Now, what I probably would do later to make my life easier is to move my investment into a pie and enable Autoinvest. Now, as you can see here, I'm investing £10 every single day into the S&P 500. Now, investing every single day is a bit excessive. I wouldn't be doing this if it wasn't for the purposes of content. But like I said, within a pie on Trading 212, I can enable Autoinvest, and every month I would invest £100, keep that going for 20, 30, 40 years. And if I can, I would try to increase my deposits as I see my money snowballing, hopefully, if nothing goes wrong with the market. Remember, when you're investing, your capital is always at risk. There is a potential you'll lose some or all of your investment. So the idea is in 40 years, I will be thanking myself and I will be a lot better off financially. So make sure to check out some of my other videos and I'll see you in the next video.